Continuing with political risk, this lesson looks at how political risk actually affects the economy and different ways that a political risk can affect different sections of the economy. So, why does politics matter for economics? Well, political risk can actually have a huge ramification on economic outcomes across all sectors of the economy. This could be whether it's growth, trade, the value of the currency, the amount of investment, incomes, GDP per capita. And the problem is that political risk typically leads to lower investment. And lower investment is bad for short-term growth, but also long-term growth and economic development. It could lead to higher unemployment, lower spending, etc. Political risk also can result in a weaker currency and exchange rate because people move their money out of that particular economy, and it can also lead to a weaker equity market, which means wealth is being destroyed in the economy. At the same time, political risk in another country or region can have a negative effect on your country. So it's not only domestic political risk, it's foreign political risk as well. And we're going to look at some of the channels and some of the policies which actually result in this political risk and economic risk. So we're going to look at some political events and then the potential economic effects. So imagine there's political unrest or strikes. Well, because fewer people are working and there's stoppages, you could expect slower economic growth. Because there's uncertainty, you could also expect a decrease in investment, which hence also leads to slower economic growth. You could see people selling their stocks and moving out of the country, which could weaken the currency and the stock market. And it could also lead to higher borrowing costs for the government and corporates because the risk is higher. And the interest rate in which the government borrows at is also determined by the amount of risk or riskiness. So foreigners or local people may not lend money to the government given that there's so much unrest. Another political event could be the election of a president who wants higher taxes. This could lead to a reduction in investment. If businesses think they're going to be less profitable going forward because they're being taxed more, they could reduce investment. This could also have a negative impact on consumption if there are higher taxes on consumption, right? Or on income taxes, you have less money to spend. This could in effect lead to a rise in unemployment because the economy slows, and it could also lead to higher cost of borrowing for the government in the event that foreigners and local people do not want to invest in the particular country and invest in the country's bond market. Looking at other types of political events, imagine if a government puts price controls. So essentially, what it says is bread cannot cost more than a certain amount. Let's say you cannot charge more than $1 for bread. Well, what happens here is that there's actually a shortage of goods will emerge. And this is because if bakeries do not find it profitable to produce and to sell at $1, then they'll just stop producing. And what that means is there'll be less supply of that good. And actually, because there's a shortage of that good, prices will even rise higher. And that's why price controls don't really work. Second of all, because there are price controls and there's a lack of profitability in that particular industry or similar industries, then there's going to be a lack of or a decline in investment because companies just won't invest. And a huge risk there is that if the government sees that some companies are raising prices in order to remain profitable, they may nationalize those companies, such as occurred in Venezuela, right? If the government is keen on keeping price controls very low, and these companies stop being profitable, and instead of shutting down production, they just raise prices, then the government sometimes can come in and say, hey, why are you raising prices? You're not allowed to do this. We're going to nationalize your company. And what they do is they continue to produce that good at a loss. So just keeping to the theme of nationalization, what kind of impacts or economic impacts does nationalization have? Well, first and foremost, there's going to be much lower business investment, which is bad for growth. So if you're scared that the government's going to come and take away your property, you're not going to invest in it. You're going to take all your money out of the economy. At the same time, if you export some of these goods which are being produced, and now the government comes in and nationalizes it, because they're not producing it profitably, they actually will produce less of it. And that could mean fewer exports for your economy because the government is not as an efficient producer of that good as a private company would be, which is driven by profit maximization. And this, again, could affect your trade balance. So a country like Venezuela, it imports the majority of things it consumes and just exports oil. And the reason why is because the business environment, the nationalizations, has resulted in a real weakening of the manufacturing sector, that they don't produce much. It's not even cost effective anymore. as such, they just import everything, and that kind of weakens their trade balance. So political risk is not only bad for the economic outlook, but also has a ramification for financial markets. And financial markets are also important because the interaction between economics, politics, and financial markets is very close, as one can impact another. So general political risk can also lead to a falling stock market. And a falling stock market is bad because, say you have a lot of your wealth in houses or in stocks. If let's say the stock market falls by 20%, then you're actually 20% poorer as a person. I mean, not poor because you still own those assets, but you're poorer relative to where you were before. Secondly, because there's more uncertainty and there's more political risk, you'll see rising bond yields and typically higher interest rates. And what this means is that the cost at which the government can borrow rises, so it's actually more expensive for the government to borrow money, so it will borrow less, it'll invest less in education, potentially in transport and infrastructure, but also those higher bond yields and the higher cost of borrowing will also impact consumers and businesses. At the same time, you might see a much weaker currency. No one wants to be in your economy because there's no confidence in it, so they start selling their assets in, let's say, Venezuela, and they take their money out and invest it back in the US or Brazil, let's say, and that means that as more money is flowing out than in, your currency weakens. And actually that's bad for inflation. Good for exports, but bad for inflation. But in the context of nationalization, imagine if you nationalize most of your factories and you're not producing much, a weaker currency won't really help your exports because you can't really produce much anyway. And political risk and economic risk and financial market risk can have a vicious circle. We're going to explore that a little bit more. So sometimes countries that face a lot of risk end up in a vicious circle of risk, whereby political risk leads to financial market risk, which can lead to economic risk, which can lead to more political risk. For example, let's say protests lead to a fall in the stock market, a weaker currency, and higher bond yields. This leads to weaker consumption and investment because the cost of borrowing is now more expensive. People are weaker because people's consumption patterns are weaker because the stock market has fallen and they feel poor. This in turn slows growth and more people are unemployed. So more people are unemployed, this could lead to political unrest, political mobilization. As people protest more, political risk starts to rise even more. Okay? So as political risk starts escalating, this leads to more economic uncertainty and potential political measures such as price controls, curfews, military mobilization, which further deteriorates the outlook for growth. Right? This in turn could lead to more financial market weakness as people take their money out because they're scared, the military is involved, let's say, or there's curfews, and then it'll lead to weaker growth and so forth and so forth. So the fact that political risk, financial markets, economic risk are all connected means that one area of risk can influence the other. And political risk is typically a large source of risk for an economy.